Joining me now is Robert Schein. He is the Chief Investment Officer at Blanke Schein Wealth Management. Robert is on the line from Palm Desert, California. Thank you for making time to chat with me. Can we begin by looking at this AI trade? I mentioned the pullback that occurred on Tuesday, the recovery today. How do you read the landscape right now where AI is concerned?
AI is still in the throes of growth go-go mode, even though we've had a stall or a setback a day or so ago. If you go back even a week and you go to the hyperscalers and mega tech and you hear how they've reported, you know full well that we are in the early stages of the AI growth story.
I want to focus, if I can, on Palantir Technologies. Shares gapped down about 8% on Tuesday. This company may have become the poster child for extreme valuations where AI is concerned. Palantir is trading at around 265 times estimated earnings. So, Robert, I'm curious, where do you sit in terms of the conversation around valuations, especially when a name like Palantir seems so incredibly stretched?
Absolutely. Palantir is one of those that is gotten way ahead of itself from a valuation standpoint, even though the story, is incredible. But, one of the ways you got to think about it, how do you invest in an environment like this? And it's all about stock selection. So while there's companies with the Palantir type PE, there are other companies that are still have tremendous room to run. Not to that extent, because we believe that's ahead of itself. But there are a lot of AI stories that are still undervalued.
So where are you looking for value? If we can talk about the broad AI picture, there are obviously names like Palantir, which we just pointed out is pretty rich in terms of valuation. There's the NVIDIA story, and then if you get into the hyperscalers, it's obviously a story about Alphabet, Amazon, to a lesser extent, maybe Microsoft. But I'm curious about how you discover value if you want to stay committed to this thesis.
We're still committed to the mega tech at the early stages right now, simply because the operational efficiency mindset, which has really become very infectious. Again, you see companies like Amazon investing like they are, getting the growth in the cloud, like we're seeing it play out, but yet they're also laying off 30,000 employees where they're still focused on the bottom line. And it's a testament that they could do more with less. So the mega tech is still where we're seeing this, simply because the AI offsets in productivity growth. Even Goldman Sachs said that it's a 1.5% accretive to output, year over year across the baseline. There are 4 stages, as we're seeing, of AI: the traditional AI, generative AI, and then the pre-AGI, and then. But we're still in the first couple of stages right now for stage 1, stage 2, and so mega tech is really leading the way. And that's where I would stay, simply because of the free cash flow and the fortress-like balance sheets.
Can you give me a sense on how much above your cost basis right now you are in some of these big names?
Tremendous. I mean, we've been in, the Apples, Amazons, Microsofts for decades. And so that seems to be the issue across Wall Street. Not only is the contribution relative to the cap weighting or the S&P index, how much they've grown, how much they contribute, but yet a lot of Wall Street's locked into, low cost basis on all of our taxable accounts. So we do trim, like we did trim NVIDIA. We do trim some of the larger cap mega tech and reinvest that and diversify that into balanced. And I will tell you, that's not the phone call you want to get from a client that sees you sell NVIDIA and just a little bit, you take your cost basis off the table and you hit a tax gain. And then they see that you invested in something like Warren Buffett and Berkshire, which is slow and steady. And over time it will win out. But it's not in the fast lane like tech.
So you mentioned Buffett. His cash position right now is at a record high, and I'm curious about the level of cash you have on hand right now.
Yeah, we're sitting about an 8 to 10% cash position across the board. And cash, I mean cash equivalents, it's still getting well over 4% for our clients. But we, again, step into volatility. We did that earlier in the year in April. And when the markets basically came to us, we saw a lot of opportunities. Much like Warren Buffett is moving forward, we keep dry powder on the balance sheets for just, whether it's a headline, a tweet, or some geopolitical event that provides an opportunity. We still believe in the growth of the market and the growth of the bull market as well moving forward.
So if there's a pullback in some of these AI names, are you a buyer, or do you want to be diversified away from some of the big gains that we have seen right now in the big cap tech space that you just laid out?
If an investor has no exposure, you jump on some of the pullbacks. If you're overexposed, overweighted in your portfolio, it's okay to start trimming into the strength. You're not going to go broke taking a gain. And over time, you could reallocate that to, again, the value play, which balances your portfolio and keeps that ballast in the portfolio when there is volatility, and gives you an opportunity. And also keep cash on the sidelines so that you're not 100% invested, so you can jump on these opportunities.
Let's talk a little bit about the macro picture vis-a-vis the Fed. I mean, if you look at the Atlanta GDP Now forecast, I think the growth that they are suggesting in compiling data is around 4%. It's unclear as to whether or not we get a rate cut in December. I think the probability right now in money markets is around 70%. Today's economic news was pretty upbeat. I mean, U.S. services activity expanding at the fastest pace in 8 months. You look at the numbers from the private payroll services provider ADP. We had job growth in the private sector jumping by 42,000. So it's not clear that the Fed is going to continue to be accommodative, at least in the short term. Or am I wrong on that?
You're 100% right. And that's why we saw the market pull back when Jerome Powell basically took the Fed put off the table of a built-in, baked-in December rate cut. And so markets are pulling ahead gains from 2026 into 2025. We still believe that's going to be the case in terms of front-running the Fed and believing that there are more rates to come. But our biggest concern moving forward is just that, the Fed. We saw that we do need the Federal Reserve to bring down interest rates to help housing, which would unlock a good percentage of the overall economy that has been frozen and stalled for so many years. But what if that doesn't happen? We're also going to get a potential reacceleration in the GDP in the new year, simply because the one big beautiful bill, the free cash flow boost to the S&P 500 companies right away, as well as to the consumer. January 1, there's a tax reduction that goes into effect in payroll taxes to the equivalent of $150 billion for next year. So that extra money, liquidity, is going to go in the system. That could go against what the Fed is ultimately trying to do, which is, put the brakes on inflation. Inflation right now is at a low-grade fever. And so, in even tariffs is that one-time inflation a bump. And oil's working in its favor right now. But again, it's shelter, and it comes down to the Fed and rates.
So where does the Fed leave you when you look at the financials and you're talking about rates? The expectation here is that we do, maybe not in December, but in the first part of next year, we do maybe get another cut. Where are you with the financials in that scenario?
Financials is a quality sector. Again, solid balance sheets on the large and mega cap names in that space. And as we know historically, when rates come down, a lot of that flows to by way of IPOs and liquidity, and just a great space to be in. And financials will do well as it relates to a lower interest rate environment moving forward.
So it's not necessarily a story about more lending. It's a story about maybe trading revenue. Maybe it's a story about merger and acquisition activity if you're looking at the big banks.
It'll unlock merger and acquisition activity and IPOs again, and again, unlock that Wall Street spirit.
Robert, we'll leave it there. Thank you so very much. Robert Schein is the Chief Investment Officer at Blanke Schein Wealth Management. He's on the line from Palm Desert, California, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.
Blanke Schein Wealth Management is a group of investment professionals registered with HighTower Services, LLC, member FINRA and SIPC, and with HighTower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through HighTower Securities, LLC. Advisory services are offered through HighTower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analysis, prices, or other information contained in this research is provided as general market commentary. It does not constitute investment advice. Blanke Schein Wealth Management and HighTower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Blanke Schein Wealth Management and do not represent those of HighTower Advisors, LLC, or any of its affiliates.